ConocoPhillips sells Oklahoma assets to Stone Ridge Energy. In a significant development within the energy sector, ConocoPhillips is reportedly on the verge of finalizing a deal to sell its Oklahoma assets to Stone Ridge Energy, a private company, for approximately $1.3 billion. This information comes from three sources who are knowledgeable about the ongoing negotiations, as reported on July 22, 2025. The stakes are high. This potential sale is not just a routine transaction, it represents a strategic move for ConocoPhillips, which is striving to exceed its ambitious divestment goal of $2 billion. The company set this target after acquiring about $5.4 billion in debt from Marathon Oil during a substantial takeover last year. Who's involved? Stone Ridge Energy has emerged as the leading bidder in the auction for these assets, with Flywheel Energy, a private oil and gas firm based in Oklahoma City and backed by Stone Ridge, set to manage the operations on behalf of its parent company. This partnership highlights the growing trend of collaboration within the energy sector, where companies often join forces to optimize resource management and operational efficiency. What's at stake? The assets in question include around 300,000 net acres in the Anadarko shale formation, which are capable of producing approximately 39,000 barrels of oil equivalent each day, with natural gas accounting for about half of that output. This sale could significantly bolster Stone Ridge's portfolio and enhance its operational capabilities in the region. Caution ahead. However, it's important to note that while discussions are advanced, there is no guarantee that a deal will be finalized. The sources have indicated that negotiations could still fall through, emphasizing the unpredictable nature of such high-stakes transactions. Both ConocoPhillips and Stone Ridge Energy have refrained from commenting on the matter, which adds an air of uncertainty to the proceedings. A broader perspective. This situation raises intriguing questions about the future of energy investments and the strategies companies are employing to navigate the complexities of the market. As the energy landscape continues to evolve, how will companies like ConocoPhillips and Stone Ridge Energy adapt to the changing demands and challenges? Join the conversation. What are your thoughts on this potential sale? Do you believe it will benefit both companies in the long run, or do you see potential pitfalls? Share your opinions in the comments below. ConocoPhillips nears $1.3 billion Anadarko sale, Flywheel and Stone Ridge set to acquire Marathon Oil assets. ConocoPhillips is on the verge of a significant transaction that could reshape its asset portfolio, potentially nearing a $1.3 billion deal to sell Oklahoma assets to Stone Ridge Energy. But here's where it gets controversial. While negotiations are advanced, no final agreement has been signed yet, and sources indicate that the deal is not yet guaranteed. This move is part of ConocoPhillips' broader strategy to streamline its operations and reduce debt. The assets in question are located in the Anadarko Basin, a region that has seen fluctuating interest over recent years. The package on the table includes roughly 300,000 net acres spread across Oklahoma's Scoop and Stack plays, two of the most prolific shale formations in the U.S. According to industry insiders, recent production from these assets averaged around 39,000 barrels of oil equivalent per day, with natural gas making up about half of that output. ConocoPhillips acquired these Oklahoma assets last year through its $17.1 billion purchase of Marathon Oil. At the time, the company announced plans to raise approximately $2 billion by divesting non-core assets, aiming to strengthen its financial position. To facilitate this process, ConocoPhillips enlisted the help of Moelis & Company, a financial advisory firm, to market the Oklahoma holdings. Over the past decade, the Anadarko Basin has taken a backseat to other major U.S. shale plays like the Permian Basin, Haynesville, and Appalachia. Several Oklahoma-based exploration and production companies faced financial difficulties, with some filing for bankruptcy or exiting the basin altogether, driven by falling oil prices and high debt levels. However, a few long-standing operators, such as Continental Resources, Devon Energy, and Marathon Oil, companies with deep roots in Oklahoma, continued to maintain a presence in the region. Recently, however, the outlook for the Mid-Continent region has shifted. Rising natural gas prices and dwindling drilling inventories elsewhere have sparked renewed interest among private E&P firms. Notably, Flywheel Energy, backed by Stone Ridge, has invested heavily in Anadarko, deploying over $3 billion into basin acquisitions over the past year. Similarly, Canvas Energy, which rebranded from Chaparral Energy in 2022, has explored selling its 223,000 net acres in the basin. Another player, Camino Natural Resources, initially considered a sale valued around $2 billion, but has since pulled back from active marketing. Based in Denver and sponsored by private equity firm NGP, Camino holds approximately 135,000 net acres in the core Anadarko region, and remains one of Oklahoma's top producers. Stone Ridge Energy, meanwhile, is expanding its upstream footprint. Earlier this year, it acquired Winkerum Asset Management, which had invested in Wyoming's natural gas sector, including a stake in Pure West Energy, a producer managing around 1,600 gas wells. Flywheel has also recently taken control of a substantial natural gas asset in Colorado's Pecines Basin from Terra Energy Partners, which was the leading producer there as of late 2024, with daily gross production exceeding 550 million cubic feet. In addition, Flywheel is a key player in Arkansas's Fayetteville Shale, further diversifying its gas portfolio. Interestingly, last year, international commodities trader Gunvor acquired a 41.67% stake in Flywheel's parent company, gaining marketing rights to approximately 500 million cubic feet per day of production. And this is the part most people miss. The renewed interest in the mid-continent isn't just about current prices, it's about strategic repositioning in a changing energy landscape. As natural gas becomes more valuable and other basins face depletion, private E&Ps see opportunities that larger, more traditional companies might overlook or avoid. But does this mean the basin is truly on the rise again, or are we witnessing a temporary rebound driven by market volatility? What's your take? Are these developments a sign of a long-term comeback or just a short-term blip? Share your thoughts below.